All right, hello, and welcome to an emergency session at the pit. This is Mickey Blindside at Checkmate Trading. Today is June 10th, 2022, Friday. It is 1:04 p.m. In the afternoon. We are in the second half of trade today. It is Friday. It is the end of the week. We've seen some interesting price action from yesterday, and so I thought it was only right that we have another session today just so we can update our plan and just be mentally ready for the next steps for next week. We've got a big week coming up next week. We got FOMC on Wednesday. Okay, and that one, I expect some fireworks. Especially after this CPI reading that we got. We had an unexpected jump or a little bit higher number than what was expected for core CPI. As well as the headline numbers. So let's see if the Fed talks about that on Wednesday. We shall see. Also, this week, or this monthly OpEx is quad witching. All right, dividends get paid out on SPY and a lot of stocks next week. And so, if you're in calls or if you're in puts for next week that expire on Friday, just make sure to account for that dividend. All right. So right now, let's say right now SPY is around 390, and let's say price stays the same on Friday. When you wake up, SPY is going to be about $1 less, all right, because of that dividend payout. So just remember that, okay, if you're trading short-term or those options expirations for next Friday, okay? I wanted to update our plan. So the plan was, if you remember here, let me go to our chart. Oh, by the way, just as just a little tangent here, Dow is starting to come to our level right here. That's 6132.34. That is an institutional buying level right here. Unlike you and I, we can buy or sell whenever we want. A lot of institutions and fund managers have mandates. They have to stay invested, and if they're in value names, they have to utilize excess cash if they see certain value levels in the stocks that they follow. This line right here is that line. This is that line for value. Okay, if it hits that, I think we're going to see institutional demand. It does not mean that we are just going to go straight up. We could still go lower, but all I'm letting you know is that this is going to be an institutional buying level right here. Okay, it could buy and then it could go up and then back down. You don't know that. We don't know. But if you're buying shares, this may not be a bad idea to start legging in to Dow if you have the stomach to be long any individual stock in this market, okay? But I digress. All right, let's go to what we're really here for. Let's get back to business, all right? So the original plan, okay, was, again, big picture, we are in a downtrend. We were in a bear market rally, and we were going to buy some long-dated puts right here. And that was not just my idea, too. There was a lot of institutions ready to hedge and short right here. Okay, this is...
Turn your screen share on, Mickey. Sorry to interrupt.
Oh, sorry about that. Okay, oops. Let me go ahead and share my screen here. I thought I had already done that. Sorry about that. There you go. Okay, sorry about that. Again, let me, just because you didn't see my screen, here's the Dow chart. Again, institutional buy level right here. This was not some, TA line or whatever you want to call it. This is a value line. This is a valuation line. And right here, institutions will buy. It may still go down, but if you're legging into shares, not a bad idea. Again, only if you can stomach going long on a stock in this market, okay? Which is not easy. I'm going to tell you right now, it's not easy. Okay. Again, now back to business. Now, again, what we were going to do was short or buy puts here. A lot of institutions were ready to do that. This was the institutional dumping ground, so to speak, right here. Everybody was ready to hedge. We're probably not going to get there. Okay. We're probably not going to go there. All right. Unless something magical happens at FOMC, that's just not going to happen. All right. So what do we do now? All right. So I expect there to be some chop into FOMC. All right. I'm not trying to predict the future. I'm just trying to anticipate the next few moves. I think there is going to be some chop. We are in some heavy put walls above, and we have some fresh new put walls on the weeklies and on the daily expirations on SPX, the weeklies on the SPY. So we have a new lower fresh put walls. Okay. So I can see us ping-ponging back and forth between those different put walls until FOMC. And then we'll see what happens at FOMC. All right. It could continue lower, or it could go a little bit up and then back down. Now, if we see any rally, if I see any rally above 4,000, I'm going to start buying put walls. All right. I'm going to start buying 3 to 6 months out. Anywhere from 75 cents to $1.25, $5 wide strikes on the triple Q, IWM, or SPY. Right now, because of where we are, I'm actually thinking about buying SPY put walls right now because of where we are. The IV has shot way up for IWM and QQQ, so. Because we can't, I think there's almost zero chance it goes up to here. Almost zero. All right. So what do we do? All right. I think we have to revise the plan. Any rally up to the 4,000 or so, I'm going to start buying put walls 3 to 6 months out. I'm going to scale in. I'm going to leave some bullets here. I'm going to leave some ammo for also 4080, as well as around 4100, 4120, 4116 or so. Around that 4150 mark is a lot of calls. And I can also see some fresh institutional hedging demand probably coming into play right here. Yesterday, as we lost 4080 at the end of the day, the last 2 hours, I saw a huge number of puts being bought right here. Okay. I remember we were in the pit, actually. There was like 3 or 4 of us. I forgot who was with me there, but I even said, hey, there's a lot of puts coming in. Maybe I should buy some puts. And then, I just kind of laughed it off and, did something else. And then boom, we just went down. So institutional demand, definitely there were some buyers here, institutional buyers. As we lost that level, the demand for hedging just became too strong and brought the market down. Again, delta hedging. If institutions are buying puts, market maker is selling those puts. Selling a put is a bullish position. Market maker is always delta neutral, wants to neutralize their books. So they will have to short the underlying to take on those short puts. Okay. So, again, if we chop around here and we get here, I'm going to start buying put walls 36 months out. Also leaving some ammo here, also for here, just in case. All right. Who knows? Most likely, I don't really see us getting over 4080. I just don't see it. But who knows? Just in case. Right now, which strikes am I looking at? It's hard to say, because right now, because IV is so inflated. Some of the spreads that I looked at for vertical debits, we're already for September. You're looking at 365, 370. They're about $1. At least, earlier today, it's probably a little bit lower now. Probably you're gonna have to go down to 365, 360. And if you want to go out even further, like October, November, you might have to go even a little bit lower than that. Okay. So let's see what happens if the market kind of, alleviates. Maybe we have a little bit of temporary reprieve, and, in the VIX at least, if it goes down a little bit next week, maybe Monday, Tuesday, right before FOMC, which is somewhat common to see a little bit of a rally. We may get up to here, but if not, then in that case, if it just keeps going straight down, I'm gonna wait and be patient. There's nothing you can do. I have one set of UVXY call walls, which is, measly. I have 10. To me, that's measly. For those $5 strike wide call walls, I needed like 500 of those to hedge my portfolio properly. But oh well, I was gonna buy 10 to 20 a week. That didn't happen. So I'll just cash out of those. It won't be that much. It'll just be like, I don't know, maybe a couple lotto plays worth of profits for me. And we'll just wait if it just keeps going down. If it just keeps going down, institutional buying will happen right around here, 3,600 to 3,500. All right. When I calculated this a couple of weeks ago, based on financial modeling using I think I used like 3.25 as the risk-free rate. I got around 3,600. I think DJT, I think you and I, we talked about this a couple days ago. I think you told me you used a risk-free rate that was a little bit higher and your level was 35.20. So it's around there. Depending on what risk-free rate you're using on those valuation models, your buying level is going to be somewhere around here. Okay. So most institutions are looking to buy this around here, and that's where I'll swing long. Most likely what I'm going to do is buy some calls that are 3 to 6 months out. Just calls, no call spreads. I'll just buy calls, delta 40, 35 to 40, most likely around 40. Delta 40, 3 to 6 months out, calls right here. Okay? If it keeps going down, that's what we do. We just wait for here. All right? If it chops around, we buy put walls on rallies. That's the plan. All right? So that's a little bit of an update. Now, I wanted to go over how to build a spread. All right? I already went over how to build verticals. I guess we can go over it again. Let's use UVXY as an example. I guess we'll go to the one that I have. Again, I still have these. They're up about 20% so far. I don't expect them to be fully in profit. If we have a huge sell off and UVXY just goes to like 20, I don't know, by next week, let's say, this will not be in full profit because the gamma effect is not as strong because the expirations are further. Your gamma effect is stronger the closer you are to expiration. So we're kind of far from expiration, so gamma is not going to work for us as much. Probably full profit if it happens soon. It's probably going to be in the 30s. So if this goes up to the 30s, most likely then my spread, I can probably get out. I mean, with the bid ask the way it is, I'll probably get out like $4.50 or so, $4.50, and I got in at 88 cents. So that'll be good. But again, measly. The number of spreads I have is not enough for me. But we'll see. Okay, so the vertical spread, just the basic vertical spread. All right. Let's use puts. You are buying something closer to in the money, and you're selling same expiration further out the money. All right. That's all a vertical spread is. Somebody was asking me, well, then, are you going to take assignment if this goes beyond your short strike? No, because you have this long strike, right? So let's say you do hold it until expiration and you get, exercised on the short. Well, then all you have to do is just exercise your long, right? So you are forced to short. Or no, I'm sorry. So when you're short a put, you're obligated to buy. All right. So the broker is going to put let's say we expire here 25, the broker is going to put 20 or 100 shares at $20 into your account. But you have the right to I'm sorry, we're on calls. I keep thinking puts because, I'm expecting the market to go down. I'm thinking indexes. I'm sorry, calls, okay? So, when you sell a call, you have the obligation to sell, all right? So the broker, if we close at 25, the broker is going to force a short position at 20, but you can exercise your 15 calls and buy at 15. So through all these exercising of options, you're buying at 15, selling at 20, even though we're at 25. So you're still collecting that $5 difference, right? So you're not getting assigned. I mean, if you do get assigned here, just get assigned here as well. And you just collect the difference, right? Again, a call, if you're assigned, you're obligated to sell. So the broker is going to force you to have a short position at 20. Then you can just exercise your 15s, buy at 15, you sell at 20. So you're not doing a vertical spread to get assigned, all right? So before expiration, you're going to sell. So let's say on, December 16th, 1 hour before expiration. I don't recommend you holding this until then, but just as an example, if we're at, UVXY 25, you can just sell this spread for close to full profit. There's no reason for you to hold this all the way to expiration. There's no reason for that. So you're not doing this to get an assignment. You're doing this as a bullish on UVXY, but it's a hedged bullish position. Okay? That's what this is. Any questions? If you got any questions, type it on the voice chat text. Was there any questions about this vertical spread and how and what the theory is behind it? Same thing goes for on the put side. You buy closer to in the money and you sell out the money. All right? Let's say you were bullish on indexes and you were bearish on volatility. You could buy the 15 puts and sell the 10 puts. You would be paying about $3.35 and your max profit would be about $5. You're not doing this to get your puts assigned. Okay, getting assigned puts means you're obligated to buy. All right, and so let's say you held this to expiration and the market maker forces you to buy at 10. Well, you can just exercise this, and as a put holder, it's the right to sell. So you're selling at 15, buying at 10, and so you profit that difference. Or right before expiration, if you're in the money, let's say UVXY is $7 or something, you can just sell the whole spread for close to full profit. Okay, so again, you're not doing this to get assignment. All right, you're doing this as a directional bet, but it's a hedged directional bet. Everybody understand? Yes, no. Just type yes or no on voice chat text. Good. Okay. Good. Nunya said he understood. So I'm sure all of you then understand, right? I'm just kidding. Nunya, I'm kidding. I love you, bro. Okay? I'm just kidding. All right. So that is the basics of a vertical. All right. I went over this in last video too. So you can also take a look at some of our previous videos and take a look at that. Now, one of the spreads that I wanted to go over, and this is for this specific event. All right. That's another reason why I wanted to have this emergency session. It is called a calendar spread. All right. So, those of you who have followed me for a while, you know that I love to talk about skew, volatility skew, right? So not only are there skew based on strikes, as you can see, as the strikes go further out the money, generally your implied volatility goes up. There's also skew based on time. Okay, skew based on time. Meaning, what we're trying to really take advantage of with a calendar spread is that shorter dated options have a higher implied volatility than your longer dated ones. Generally, that's not the case. Generally, as you get further and further out in expiration, you tend to have higher IV in those because there's more risk, right? The more time there's more uncertainty about what future price is if the expiration is further out. So it's only natural that longer dated options are going to have higher implied volatility. Well, sometimes that's not the case, especially with earnings releases and as well as binary events like FOMC, elections, things like that. Sometimes the shorter dated options are going to have higher implied volatility. And that's why always when I do ER plays, I always harp about spreads. Why? Because there's going to be a lot of implied volatility crush. No matter what the outcome is, whether it was expected or not, that implied volatility is going to get crushed. Okay? So let's go over a calendar spread, all right? So one of the calendar spreads that I'm looking at right now is in SPY. This one is you are selling the June 22nd 380 strike, and you're buying the June 30th 370. And this is the payout, what it would look like on the 15th. Okay? If we go to Friday's expiration, this is what could happen. And why is that? Is because your short strike, the one that you're selling that's closer dated, has a higher implied volatility than your long strike. So let me just give you an example, okay? So I already took some screenshots of all this. This is SPY. This is June 10th. No, that's June 10th. I need June 17th. So this is monthly OpX for SPY. Look at the implied volatilities. Look at this. It's in the 34s, 35s, 36s, 37s on the put side. Okay, I'm doing a calendar on the put side. So let's just look at the puts. All right. If you go out to June 30th, look at that. All the implied volatilities are less. So there is a time skew. There is a time skew. Okay. Shorter dated, higher implied volatility because of a binary event. The binary event in this case being FOMC, the FOMC meeting. Okay? So what I want to do is have a bearish position, yet have some of the premiums paid for by this implied volatility crush. All right? So what am I going to do? I'm going to sell a closer to in the money put and buy a little bit further out, not a lot, a little bit further out, further dated put. Okay, so in this example, in this one that I highlighted here, the one with the check mark, I'm selling the June 17th 380 puts and using that premium to buy the June 30th 370 puts. Right now, it's a slight debit. Okay, ideally, you want to do this trade as a slight debit or a credit. Okay, well, I guess ideally you want to do it as a credit, but slight debit is acceptable. Okay, a slight debit is acceptable. Actually, before I started the video, this was at around 5 or 6 cents. So it just shot up because the market just went up a little bit. As the market goes up, that debit could increase. Okay. Now, here's what happens in this scenario. Okay. Let's say after FOMC, the market just runs. Okay. Just keeps going up and up and up. Okay. It just goes up. What you're losing then is you could potentially lose your debit. Okay. How much you put into it. If the market just keeps going up. All right. What if the market just shoots down? Well, as long as by June 17th, you're above 380, that's totally fine. What you really want, ideally, is for by next week, SPY to close over 380. That short put goes worthless. Now you've got a 370 put that you've only paid $20 for, and it continues down. All right. So if I extend the date to the 19th, well, the 19th is a Saturday, but I believe the 21st is, no, 20th is a Monday. So on Monday, if this is expired worthless, then you just have unlimited upside because you have still that long 370 put that you only paid $21 for. Okay, if you look at it now, I think it's like $300 to $400 or something like that per contract. So ideally, that's what you want. You want this. If you're gonna use this diagonal spread, the 380 June 17th puts and short, and long the 370 June 30th put. Ideally, you want SPY to stay over 380 by Friday's expiration, and then continue its way down. Now, it could just go down, but not go down enough. Maybe just close at like 382, and maybe it goes back up. That's fine. Just, take your loss on the put, or you can hold on to it. You paid very little for it, so it doesn't matter. And you can just keep a very cheap lottery ticket, or just sell out when it goes to like, $100 or $50 per contract. Then you take a little slight profit, and that's it. You set up for the next trade. All right. If it just keeps going up, like, and you don't have time to manage, and it just doesn't manage, and you don't manage the position, it just keeps going up against you, that's fine. You just lose whatever you paid for it, which is $20, 22 now. Okay. The worst thing that can happen is if this thing just before Friday just collapses and goes beyond 380. Okay. Now, if it goes beyond 380, your 370 is going to work towards you. And according to this analysis, your break even for Friday is at around 270, let's say 273, 275 or so. That's around your, no, I'm sorry, not 270, 375 or so. Around 375 is your break even. SPY 375. So probably, if we, by Friday, if it dumps after FOMC, and if it gets to, let's say, if it starts dipping under, I would say even if it starts challenging 380, just get out of it. If it starts challenging 380, just get out. Manage the position and just get out. Collect your small profit and get out. The collateral that you need is the difference between the two strikes. So it's $10, which is $1,000 per spread. Okay, that's the collateral. That's your max loss on this, is $1,000 a spread. So worst case scenario, you lose $1,000 a spread. If you sell early and you manage the position here by Friday, let's say, and you're around 380, you can make about $400 per spread. All right. Ideally, you want this to close above 380. Your short strike expires worthless, and then your payout structure changes. Then you have unlimited upside if this dumps next week, or the week after, I should say. All right. So this is one way of using volatility as your friend. You're taking a bearish position. We all want to buy puts, but we need a way to manage risk, and if possible, I want the market to pay for a piece of that. So how do I do it? I try to have the market pay me that implied volatility crush on the front end. The math is in my favor because the implied volatility is higher on the strikes and the expiration that I'm short on. Okay? We're using math to give us an edge in this trade. All right, I would love to have a free or cheap lottery ticket on the downside. Wouldn't you? Any questions on this? Any questions on this calendar spread? All right, unmute yourselves, guys. Ask away. Unmute. Mitch, you can unmute yourself if you want. Okay, no questions? Ari, do you have any questions on this? Nunya. Okay. Carter, I see that you took yourself off mute for a second there. Do you have any questions?
No, I was just say pretty clear cut, man.
Okay. All right, very well. Okay. Nunya, I see you typing. I'll wait for your question. Okay. In that case, I'm going to stop the recording here. Again, this was an emergency session because of a change in plans because, hey, the market just threw us a curveball, so we need to form a plan, right? I'm going to enter this trade closer to end of day. I want to get this debit down as far as possible. I also have other examples here too. This is other, other risks, other expirations. Generally, I want to be long 3 or 4 weeks out. And on my back tests of this during FOMCs, usually that's what worked best. Is if you buy about 3 or 4 weeks out. And then you want to sell what expires that next week. And generally, doing it on the Friday before FOMC gives you some good theta burn as well too. So ideally, you want to place this today. And again, long strikes generally 3 or 4 weeks. Although I will say that the strikes that are June 24th, they're also pretty compelling too. But you're going to have to sell something that's a little bit closer to at the money. And if you're willing to take that risk, then, I mean, your max loss is actually less. But you are taking a little bit more, I guess, closer directional risk for the next week. But your overall risk on the trade is lower because your max loss is lower. So you can play around with the different strikes and see. And use tools like this where you can analyze different options payouts. Another one is the July 8th 360 and buying the July 8th 360 and you sell the June 17th 380. You can still do that at a 28 cent credit, and that's pretty good IV crush. You still have that risk. Actually, if you want to see that payout, it's already saved here. You can do this one too. Since the strikes are wider, your max risk is actually $2,000 per spread. But again, you just need to start managing the spread at 380. Your break even comes around 375. But you're doing it at a slight credit. So if this just runs away, at least you can collect $20 for each spread, which is about 1%. You're putting up 2,000 in collateral, collecting 20, 25, whatever bucks. That's about 1%. That's nothing to gawk at. Some institutions would love to make 1% every couple of weeks. If you annualize that, that's actually pretty good. Most people underestimate that too. So if you want that credit, you can always do that. You just have to set your strikes a little bit wider. And also too, if the sell-off is just not as deep, then your upside on the for the weeks after is not going to be as much because it's a lower delta and further out the money. But you do have more time. You have until July 8th, instead of June 30th. But for me, I just like this one better. I think I'm going to use this one. I'm going to try to get this debit down as much as possible, but we'll see. Okay. So guys, I'll try to be back online in about a couple of hours for the close of day. But this was a great session and trade safe. I'll see you guys soon.